They really provide a framework to systematically embed sustainability across all levels of a financial institution. So from banks, from their strategies, from their portfolios to transaction levels across core areas of the business. They set a global benchmark to really see what it means to be a responsible bank. This is really about redefining the role of the banking industry in helping to shape the sustainable future for society. So what they actually are, you may have seen some of this already. The first principle that the banks have committed to, that's over 130 banks with around 47 trillion in assets already committed to these principles. They have committed to aligning their business strategies with the UN Sustainable Development Goals and the Paris Agreement on climate change, as well as regional and national frameworks. They have committed to setting targets to address their most significant positive and negative impacts in core areas of their businesses across activities, products, and services. And they have committed to working responsibly with clients and customers to promote sustainable economic activities and practices. They'll be consulting, engaging, and partnering with stakeholders responsibly, so that includes regulators, civil society, and others who are key to the transition to a sustainable economy. And they will be implementing the principles through effective governance and a culture of responsible banking. It's already been said today how important governance will be, and that this really needs to be run throughout the bank from at all levels of the system. Now, to make sure that there is progress in implementation, there is an accountability part of the principles, Principle 6, where banks commit to reporting on progress. And this is, of course, very important. And within 18 months, you'd be seeing the first reports from banks on how they are actually implementing the principles. So one of the first steps that the banks will need to take is to identify impacts, the positive and negative impacts across their businesses. And this is in order to then set targets in the key areas of the business. So it's really looking at how can they align their business strategies and their targets with the areas that matter most and where they can make the biggest difference. Of course, target setting will need to focus on how to align with the Sustainable Development Goals and Paris Agreement, so they would need to set at least 2 targets. So it could be climate, of course, but it needs to be other areas as well. The targets need to be specific, measurable, achievable, relevant, and time-bound. And although the banks are expected to set targets individually, they have actually already committed to collective climate commitment for action. And that includes ING, Standard Chartered, and Triodos Bank have been among 32 banks that have committed to aligning their lending portfolios with the Paris Agreement. So going well below a 2-degree trajectory and striving for 1.5 degrees. Of course, the real test will be implementation. And within 2 years, UNEP FI will be publishing a stocktake of the first look at collective progress across the signatories to the principles and to see progress.
So why did we sign up? The quick answer would be that since I was the chair of the banking committee that made the decision, it would feel somewhat strange if ING didn't quickly put its pen to the paper. But actually that was in conjunction with a process that was going on at ING, and then it turned out, when I got to know my colleagues in the principles development process in many other banks, of rethinking what we should be doing, what we wanted to do, and what tools were out there to help us. Member banks of UNEP FI had a point of reference being the Statement of Commitment, which is what everyone had signed when they joined, which is more or less an acknowledgement of sustainability of an issue, but no real driving obligations beyond that. And we felt that that was a little bit outdated and needed to change. At the same time, we had the Paris Agreement, the Sustainable Development Goals, other frameworks becoming more starkly into focus for the financial sector, such as the UN Guiding Principles on Human Rights. So it was clear to us, and indeed it turned out many of our peer banks, that a change had to be needed. The expectation outside was that banks needed to be far more accountable and transparent in terms of measuring and demonstrating exactly what they were doing, and actually informing their strategies for sustainability on the basis of real thought and real science. And through that, we realized that it wasn't just an update to a commitment to sustainability that was needed, but a comprehensive overhaul, and with all the tools that would go along with that. So looking around, we saw that this kernel of an idea that was then within the UN UNEP FI Banking Committee actually would provide us with a great way of establishing, and a great platform through the UNEP FI for establishing a global framework for reference.
I think if I pick up on one word from what you've just said, and I would agree with much of what Stephen has just said, it's that global phrase. So there is a really pleasing groundswell of movement on sustainability in the banking sector. We're all on our individual journeys, but for us, the UN PRB as a bank operating in 60 markets in Asia, Africa, and the Middle East was an opportunity to come together to be part of a platform that was appropriately global for that, and for us to be able to work alongside a group of peer banks from across our network and to share with them some of the experiences and some of the places we've been on the journey, because we've been working on some of these problems for a while, and some of this is about, I think, hopefully, a little bit more standardization and harmonization, but also recognizing that there's a lot we can learn as well.
Thank you. James, what difference is it going to make to how you do business at Triodos, since you're already quite a leader in this space?
Yeah, well, it's great to be sharing a stage, even if I'm slightly separated from my panelists on this chair. And as a sort of I mean, we've been a leader in positive impact banking since we were founded, but we made a very conscious decision not to just be a niche bank, because we can't achieve what we need to achieve in terms of the scale of global challenges doing that on our own. So we recognize that we have to go beyond what we were doing in terms of financing change and look at how do we change finance. And these kind of initiatives, these joint collaborations, are really important within that. Likewise, like I'm resisting the temptation to lie down on this massive couch that I have to do the full Rees-Mogg. I think that Triodos is equally not going to rest on its laurels in terms of thinking, well, we've been sustainable for 40 years, why don't we just say, well, everyone else has got to catch us up. That isn't good enough. We have to think about how we keep stretching ourselves. So we're looking at what are the things which we need to do. So we've just gone through a whole process of carbon accounting through the partnership of carbon accounting financials, being able to get insights at a very granular level at some of our clients, and thinking, well, where are there still possibilities for savings, even amongst those who are already considered the leaders in their field?
The most salient sustainability issues do differ market to market. I really liked Dr. Adiola's comments this morning on some of the context in Nigeria around, you looking at financial inclusion. We hear a lot, particularly as we're working in Africa, about the high rates of youth unemployment and the need to resolve some of those to help economies prosper. And yet, of course, as we come into more of a Western setting, and increasingly in Asia, climate change is undoubtedly the number one topic. So, and if we bring that internally, we have 86,000 people, 120 nationalities. They are both professionally and personally going to be engaged in a very wide range of sustainability topics. So I think it's about trying to put a little bit of structure around that and say, well, there are some issues that are always going to be part of the conversation. And as we were one of the launch partners for Project Everyone, which was tell the world about the global goals when they were first announced. And we've been very closely involved since then in trying to think about what is it that we do as a bank that is our strategy across our markets and connects in with the SDGs. So we're a very large trade finance bank. We have a large retail business. We do a lot of sort of last mile payments. So how does that give us an opportunity to contribute to some of those SDGs? But then also with things like climate change, how can you say, okay, as an organization, to as you mentioned, the collective goal on climate action, how can you say at a senior level, we need to achieve Paris, otherwise we've all got a big problem, so we're going to support with the entire of our organization to align our lending book to Paris. So I think that starts at the top, and the PRB was great because it required that senior sponsorship from the top. It meant that we had those conversations at our management team and our board about concretely what did this mean, what are we doing already, and then I think it enables us to have a series of conversations within a structured framework across the rest of our footprint with our clients, but also with our colleagues internally. Your
bank has a mission for positive change. You've been looking at impacts for quite some time. What new targets are you setting under the principles for responsible banking around, for example, the SDGs?
Yeah, I mean, in terms of being able to stretch our own goals, I mean, we've already started to go further in being able to get insights within our business. So our carbon accounts, which you'll see in our annual report, give quite a granular sort of picture of where we are, and so we can go further then in terms of what are the sectors which we need to expand upon. We also need to think about what our role. So when we did the work on the SDGs a few years back, we were recognizing, well, we financed lots of renewable energy. We've only financed renewable energy these last sort of 30 plus years. But just doing more wind farms and solar now that it's a mature market, thankfully, 20 years ago when I started, and you had a single wind farm, I was the only person you could call in the UK to actually get finance. That system has absolutely transformed. We heard earlier today about the progress in Scotland. So we need to think, well, what is it we need to do? What does leadership then look like? And I think within the energy system, there's a lot of things in terms of storage, efficiency, the integration of EVs, all of these more systemic challenges, which are more fragmented necessarily. They need more relationships to be built. And it's not just going to be something that automated finance is going to solve for us, because that's just going to make more efficient the solutions which we already have today. The role of banking in the real economy is going to be about finding the new solutions.
Recessions make people fearful. Recessions cause people to curtail the time horizons over which they're making decisions. And so if there are two things that worry me particularly that I think we need to think about if we're heading into a recessionary environment. One is, the first panel talked a lot about what needs to happen in the real economy. And so already, regrettably, we collectively as societies are not on track. You know, we've set laudable and incredible goals in terms of net zero by mid-century, but societally we're not on track for that at the moment. So the first is, banks can only be in service of their clients and what their clients are doing, and we must be very careful to avoid a situation in which there is backsliding on climate ambition in a recessionary environment. The other is thinking about the culture and decision-making within financial institutions is people tend to cling to what they know. Now, I think to Stephen's point, there is now a long enough history of experience with financing new models, new ways of doing things which support the low carbon transition. But I think we must also be very careful within our own organizations not to see that if things get tough in the economy, we move back to, oh, well, we know how to finance reserve-based lending in oil and gas, for example, but we don't know how to finance the circular economy, so let's not try.